The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst Graham Whitcomb from Vancouver, no less. Welcome, Graham.
Hi, Gaurav.
You're becoming a bit of a regular now, Graham. It's great to have you on board again. And
Thank you.
from our Melbourne studio, dog somewhere out of sight, is Mickey Mordick. G'day, Mickey.
G'day, Gaurav. Hey, Graham.
Now, if we're here barking in the background, it's either Mickey protesting loudly at an idea or the pooch is loose. You'll let us know which one, I trust.
This is like that. Is this like that radio show where you have to guess the sound?
Oh,
we could do that as a special.
Thank God for podcasts, right? I remember when I first got a car, it was just perpetually on FM radio, and I used to just despise FM radio so much. It's one of the worst inventions ever. I'm so glad we don't have to put up with it anymore.
I still listen to it.
Well, the music's great, but everything in between the music is just horrific.
Yeah.
Well, whoever that inventor was, Gaurav's
needs
looking
a slap
for you.
across the head.
Yeah.
No, actually, no. The FM radio is fine. It's the inventor of the DJ who curates it all off. Anyway, getting
it's
shivers.
actually all done by algorithms now. The actual people talking on the radio aren't picking the songs.
Yeah, but they're still talking.
Well, you know how they're saying they're like, well, I guess we're going a bit off topic here, but if you get smart radios, everyone's going to be listening to podcasts and stuff. But if you have a smart radio, you kind of know your customer, and maybe you can tailor the ads and stuff. And like Spotify costs money, radio's free, so.
Well, this is actually the but that's isn't that the buy case for Spotify? That's the whole point why they're paying millions of dollars for podcast content. It's so they can really target niche advertising all the way down. Podcasts are amazing that way because they got this really specific long tail of content. So someone who's listening to a gardening podcast or fairy tale podcast, they have very specific interests and specific advertising needs. I think it's pretty interesting. I mean, I think Spotify, it's a shame we can't really write about it. I think there's a lot to commend that business. It's quite interesting.
Yeah, for sure. I use it. I love the product. But I mean, if you have like smart radios that can sort of know the customer, and you're getting a free service as well. I mean, yeah, I don't know. I don't really know what kind of ferry. Anyway, we should probably.
We're going to Instagram the fairy tale podcast.
Oh, right, yeah. Okay, so we'll keep an eye on the Instagram.
If you haven't visited our Instagram page, now is a good opportunity to do it. Now, speaking of fairy tales, actually, Mickey, what a great segue, because we have one right here. Right here. Once upon a time, there was a business called Lendlease. And when I was going through university, and when I first started investing, when I thought of a blue chip, the image in my head was Lendlease. It was one of the best businesses in Australia. It was considered bulletproof. I would say Lendlease back then, sort of in the 90s, was what Wesfarmers is kind of now, considered this really well managed, fantastic capital allocator, wonderful business that can with a few dents in it. That was Lendlease 20 years ago, and it has really fallen. It's probably one that I wouldn't even think of looking at. And I woke up one morning and found it on the buy list. So my question for you, Mickey, is why the heck are we recommending this?
Yeah, it's a great question. So Lendlease, as you say, it's obviously used to be one of Australia's best businesses, and I think up until the year 2000, they recorded something like 25 years of just consecutive profit growth. So they had, a really good world-class development business and project management and kind of construction business. So, they worked across really big developments, sports stadiums and things like that, more so today, and kind of building out, residential developments. And they also had this financial arm, MLC, which NAB now owns. So the problem was that it was just mismanaged,
right.
essentially. Yeah.
I always had this suspicion, and I wasn't sure. I don't know how true this is, but looking back with sort of zero evidence, and I don't know the numbers at all, but is it the case that the MLC business was actually growing and flattering the rest of the business, or was the development business at some stage actually a very high quality one?
Oh well, I think the development business was a good quality business, but it was so the MLC business they sold in 2000 seemed to be going pretty well. I think it was specializing in funds management, more
Yeah.
financials, and things like that. And they actually got a really good price for it back in the year 2000 because I think NAB just sold it for pretty much the same price that they
Yeah,
sold it for back in 2000.
that's right. Yeah.
Um, so they just used all that cash and they went off and they bought instead of like giving the money back to shareholders. And this was obviously after the founder had died. So it's one of those, I guess, stories where
Oh,
it was a founder-led business who had
I
been run
see. I didn't
really,
realize
really
that. Okay.
well.
Right.
Yeah, yeah. So Dick Dusseldorp was kind of this Dutch immigrant who came in. And
Mm.
he built the company up and ran it. Really, really well for many decades, and then obviously as he passed on, then it was it was given to new management teams who had ambitions to go off and
I
buy
see.
stuff
Well, they had
and
ambitions, they had license, and they had cash. Well, the trifecta was all there.
yeah, well, exactly, and they went overseas as well, which is always a
Mm.
risk, especially. It's very hard, and back in those days as well, back in the old days of 2000, the internet wasn't really as the world wasn't as connected, so it's pretty hard to keep an eye on those overseas businesses.
Yeah,
Or
the term interweb was used non-ironically.
yeah, so so I guess it's no surprise, that those acquisitions didn't really work out.
Was it in the UK, Mickey? Is that where they went? Did they went and built shopping malls and things in the UK? Is that right?
Oh, they did a whole bunch of. I think they bought like 6 or 7 different businesses, and even a couple of .com investments. If
Oh,
I,
of course they did. Yeah.
the year was 2000, and it was you were crazy if you weren't buying them. I guess so.
Crazy if you weren't, and crazy if you were.
so Yeah, so that's kind of it. And then I mean, so they did brought in a new chief, and he kind of he right sized the business, and they looked like they were getting back on track. And then the GFC hit, and
Hmm.
then they actually weren't in too bad a position. They had like a fair bit of cash, and gearing wasn't too bad, so they were in a good position to maybe capitalize. But they they bought this engineering business in
Who did they buy that
2010.
from? Do you know?
I can't remember the company that they bought it from. No,
And
but
2010, of course, was the height of
it was
the
some
engineering
German company, I
construction
think. I
bubble.
think. Yeah. I mean, it was just a business. I think they thought that it would fit in and help them win contracts for other development work and things, and it just turned out that it's just been a really bad performer. And so the way that these engineering businesses kind of work is that you've got a government, they want to build like a train tunnel or something, and it's a really unique kind of bespoke project. The costs are hard to estimate, and the risks are hard to price properly, and you take on, as a constructor, you might only have a few months to bid on a project and do your due diligence, and you're competing against others as well, so there's kind of an incentive to price underprice these contracts, and so you just get stuck with these engineering commitments where you've got to build out the tunnel, and maybe you haven't priced it properly, but you've got a fixed price, fixed time contract anyway.
Mm, mm,
So it's just you can lose a lot of money if you don't price them correctly,
mm.
and it looks like they weren't. So that's kind of been the story of why Lendlease has gone in a very shortened abbreviated version of the story of why it's gone from being one of Australia's best businesses, I guess, to today
Mm.
just being pretty much discarded. And
So just to summarize, so it sounds like it was founder led. The founder left and sold a big chunk of the business for billions of dollars. New management came in, had the funds and the ambitions to grow the business, and just spent that money unwisely.
yeah, I think you could probably summarize it as such. Coming back to your original question, so why are we upgrading it? I think
Mm.
the opportunity now is just that they are kind of shedding some of those problem businesses. So they've gotten rid of the engineering business. They've recently sold their services business to ServiceStream, and because people have been burned on this company for just so long, and it just hasn't gone anywhere for 2 decades, I just think that the market doesn't trust the turnaround story here, and
Yeah. That's actually a really good point. I mean, it's one we've talked about before with coal. But when you first raised the idea, Mickey, my instant reaction was no, 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 no. I mean, I wasn't even prepared to hear you out. And whenever you get that reaction, you just got to check it because it's often the sign of a decent idea brewing.
Yeah, well, I mean, if anyone has the time and wants to look at the article that we published, I don't think I've ever published an article that's received more negative comments.
Also a great sign.
From
Also a great indication.
Well, I mean, it was
Mm,
just universal. It was. I don't know if anyone even bought it.
yeah.
There was maybe a couple of people, but I think, it's just one of those things that just looks so ugly, and sentiment is just so bad that I think that might be the opportunity. I mean, there's certainly some risks, and we can kind of go into those as well.
Well,
But yeah, I
before
think
we
that's
do,
potentially what the opportunity is. Yeah.
before we do that, let's just talk about what remains. So you've said they've shed some of their problem services, problem businesses, which includes the services business, the engineering business. We kind of know about those. We know they've been poor businesses. What's left of Lendlease, and is it any good?
Yeah, so now what kind of remains is they've got this global kind of development business, and so that goes
Can you
in
just
that,
explain what development is in this context?
yeah, sure. So they kind of they're designing, planning, building, big urban projects. So like say a government client or even a large corporation
Hmm.
wants to repurpose, a big block of land, and they want to bring it up to the 21st century. Then someone like Lendlease can design that, manage the whole process in house, and so they capture obviously some development margins and project management fees along the way.
So they do they
Um,
actually own the fleet of construction um, equipment, and do they actually build it, or they just kind of they subcontract the build as well?
Yeah. So they don't retain. They do have a construction arm,
Yes, that's right.
yeah. So which caters to a lot of their own internal projects, but they do obviously. I think it's a mix of internal and external, depending on the project.
Mm.
But they've got a really good track record of delivering on these kinds of projects, and if you look at things like Barangaroo, I remember when I was in Sydney, just you see new things getting built there all the time, but it's actually a really nice part of the city now, and I don't think it used to be.
Mm.
And Yeah, so I think they've kind of proven the core business there in that development arm is globally kind of recognized as doing really high quality developments, um, and so that's why they've recently won like a $20 billion project with Google. Their pipeline is growing of these development projects. Um, but I think um, the longer term story is what they can do with those projects is as they as they build a new office building, or they build a new block of apartments or something like that. They can sell them off, or they can retain some for like the rental income, or they can put them into funds, and then they can spin off those funds and collect funds management fees. And so over time, it should be transitioning more towards a recurring revenue type model. And so the core business, it looks like it's intact, like they're growing funds under management and they're winning new contracts. So it really does seem like it's just a matter of getting rid of the underperforming divisions,
Can I
and
just get a
hopefully
Can I get a
you know,
clarification here? So, I mean, if so, let's take the Google example. So, they're building an office block. I understand for Google. Would they actually own the office block, or they're just kind of designing and constructing it, and it's owned by a landlord or Google themselves?
Well, I think so. The Google project specifically was to address kind of the issue that you got all these really high paid developers moving into San Francisco, and that's kind of pushed out a lot of the affordable housing in San Francisco. And so, to address that, I think Google's kind of working to build out more supply of affordable kind of rentals and stuff like that. And so they basically partner, with the landowners, and so they draw down on the land as they, come up with a new development, and then they kind of, it's sort of a fluid process where, over the next 10, 15 years or 20 years even, because these developments do stretch out for a really, really long time. They are just, they're building up amenities in the area, and they're, building out new stuff. So that's kind of the idea, really.
But they don't actually. Do they own the underlying property at the end?
Yeah, in some cases they do. So not all of them. So they like the landowners, they've got like land management agreements, but in many cases, like they'll have the end development, and they will actually own that as well. So it all depends on the the individual project and what they're working on, of course. But so you can kind of think about this as kind of part development and then part fund manager and also part property owner. I think is the right way to see it. There's sort of some evidence now as well to show that, like, that they are really kind of taking this seriously. Like they've refreshed the board. They brought in a new chief and CFO. The engineering business has been sold, as we've said, and most importantly as well, they're kind of disclosing key metrics that are going to keep them accountable. So, and I think that's a good sign. Like they're talking about returns on invested capital. They've clearly outlined their targets in terms of like an $8 billion development pipeline. They've kind of said this is a 10-year strategy, which shows some good long-term thinking. So yeah, I mean, I think that's the opportunity. There are obviously some risks here, and there's the risks of, it's not easy to get out of some of these engineering deals, and they've got, for example, Melbourne Metro, which has had just cost overrun after cost overrun. They've still got to manage that and complete that project, and there's always the chance of more accounting surprises. It has had a history of write downs and provisions and things like that. But yeah, I mean, if we don't see management, we just want to see management isn't going off and buying crazy things. And I think underneath it all, there's a decent development business here, and potentially that could be hopefully the opportunity.
Before we talk about valuation a little bit, Graham, can I get your reaction? I mean, we had pretty swift internal discussion about this, but what did you make of the idea? Are you tempted by it? Does it turn your stomach and absolutely disgust you? What are you thinking?
I think it's interesting, an interesting idea. The thing that comes up in my mind is how much their reputation translates to them actually getting better bids, or like, no matter what their reputation is for quality, does the bid still end up going to the person who's offered the lowest amount? In which case, there'll always be this perpetual problem of cost overruns and that kind of thing. Or do you think that as they're building their reputation, it does flow back to a better bidding process?
Oh yeah, no, I think it does, because like from the perspective of like a local government or something like that, you want to I think you need to be able to trust the operator that you're dealing with. These are multi-decade development projects, and so having that past track record of kind of award-winning projects across many cities across the world, they've shown a great track record. They've got the people and the talent to be able to build really nice places. I think that does count for something, as well. I mean, price is probably always going to be an element, but it's probably not the only consideration. So, but yeah, it's definitely a very different business to the legacy kind of engineering business. But there's always going to be cyclical element to this as well,
Mm.
because property prices um, can fall uh, and so that's obviously not good for them. Or there's like obviously impacts on rental revenue and um, things like that, or access to credit markets can all
Mm.
have a bit of an impact on this business as well. So it's definitely not a riskless idea. And nothing is,
Has
but
the
yeah.
management changed as well? Since is that the catalyst for selling parts of the business off? Well, I mean, what's changed inside the company to kind of prompt better management and better action?
Well, I think it was sort of a board. The board has been pushing, and I think it's also just been probably shareholders getting a bit fed up as well.
It's only taken
So
them 20 years.
yeah, so it's been a really slow process, but it seems like they're finally just getting around to it. So yeah, so the new chief is sort of he's just gotten started, I think, in July. So we
Okay.
still just very early to tell, and I think they report their results next week. So we'll keep an eye on
Mm.
that, and we'll definitely have a good listen to what he's got to say. But
New
yeah, I mean,
management's a really good indicator. Even if even if the individual you don't know, the fact that the board has kind of pushed for change and got a new CEO in there kind of indicates that they want something to change.
yeah, exactly. And so the new chief and CFO have both come. They've both got backgrounds kind of working in Asia. So I wonder if maybe more of
Mm.
Lendlease is maybe thinking more about that next leg up for the Asian growth story. So maybe Asia could be more of a focus. I'm not entirely sure, but we'll probably find out a bit more over time.
Well, I did not expect that I'd ever have such a long conversation about Lendlease, but it's a nice update. Good idea, and thanks for extrapolating. I think I understand a bit better now. Um, Mick, Mickey, Graham, anything else to add before we move along?
No.
Very good, because I have a crazy, wild, and maybe reckless idea of my own. Like Mickey, I'm going to talk about a business that's had an awful track record that I never ever expected to own or want to own, and that when I first bought it up, there was a few, I think, stomach churning gremlins and a lot of dissatisfaction, and that's Karoon Energy, which I've kind of disliked and been very harsh on over the years. Now, Karoon has a long and mostly awful history. It was started in 2003, listed in 2004. The odd thing about it, it has been a founder-led business for most of that time, and the founder has overseen some excellent exploration success, and they've also overseen some disastrous capital allocation, management behavior, and just decision making. And it's a good antidote to the idea that founders are always the the better managers than sort of professional managers. I know that's generally the case, but there are exceptions, and this, my friends, is certainly an exception because the I only got interested in this once the founder actually left the business, and it's not often you say that. So what's happened is back in 2008, 2009, they sold a big gas discovery they'd made with a super major, and they sold it to Origin Energy for sort of $600 million US cash. 3 years later, Origin actually wrote that entire purchase down to zero. So it goes to show that they really they got a bit lucky, but that luck resulted in them having a really fat pile of cash, which management just milked. They had exploration all over the place. They paid quite high salaries. There was lots of controversy about the pay going to management, and also the fact that the founder had brought along um, a couple of family members to sit in key management positions and board positions. For example, the CFO is the founder's son. It doesn't have any accounting qualifications, but sits in the CFO desk, which that's all I'll say about that. But it's highly unusual to have a CEO without accounting qualifications. Um,
That's
so
a
the
red flag to me.
CFO or CEO?
CFO,
Oh yeah,
Chief
yeah,
Financial Officer.
yeah,
Yeah,
yeah.
very unusual to have a related person without accounting qualifications sitting in that role.
Yeah, especially in that position. Does that not worry you?
Well, that's why I haven't touched the stock for 10 years. But things have changed, Graham. It's all right. It's all right.
They've
Things
got
have
an
changed.
accountant in.
Well,
QuickBooks.
Yeah, geez, these
so for a
accountants,
long
they're hard to
time,
find.
despite finding a few interesting oil and gas deposits, they've actually never, in their near 20-year history, they've never produced a barrel of oil. And this was led
That's
to
red flag too.
that's red flag too. And they've often traded below cash backing, which is actually for me a red flag as well. If a company is sitting on a big pile of cash and is trading below that cash backing, it really tells you that the market has zero confidence in the management and zero confidence in the prospects of the business, and you need to know something vastly different or vastly superior, I think, to be able to confidently buy that stock.
So Gaurav, then so you might be about to explain this, but I'm just looking at the share price. It looks like it got up to like $10 or something.
Yeah,
So what
that
if
was
if it had all
yeah.
these problems? How did that happen?
Well, that was that. It got up to $10 when it found the gas and made the big sales deal with Origin. That was quite a long time ago,
Ah, okay.
and the share price rocketed. Remember, this started as a penny dreadful. It was an anonymous exploration business, and it went all the way to $10. I think it had a market cap of $2 billion about 10 years ago. And just for context, the market cap today is $700 million. So it's been a disaster, really. And the market cap has halved despite them having a lot of cash on the books. This is not a business that's had to kind of scramble around for cash. They've always had plenty of cash on hand. So it's been a disaster, really. And the reason I got interested in it is because last year or 2019, in fact, there was a change on the board. A lot of shareholders have been angry and agitating. The AGMs have been quite confrontational, and shareholders finally, I think, managed to get some change. And a fellow called Bruce Phillips found his way onto the board as chairman. Now, I've been familiar with Bruce Phillips because he's the founder of AWE, a former buy recommendation, and I used to own the stock, and I've been following him for a long time. He's a competent, honest, and decent operator. So for him to join the board, I thought, okay, that's interesting. And then kind of a short time later, they made what looked to be a really good purchase. They bought a oil field offshore Brazil, off Petrobras. Now, Petrobras is the Brazilian national oil champion, and they have been going around the world selling a lot of their shallow oil fields. This is a multi-$100 billion business, and they've had specialization in super deep water drilling, and so they want to specialize in that, and they're selling a lot of their shallow water, smaller fields. And so Karoon sort of picked this up for 665, I think it was, US million dollars. And I thought, okay, that's interesting. They've got a production asset now. They've got a good chairman on board. And then, of course, Corona came along, and the oil price went to zero, and Karoon just got walloped because they were going to be raising capital and taking on a little bit of debt to buy this field, and share price and the oil price was negative. So it looked like the business wouldn't survive. But of course, we all know what happened next. Stimulus, low interest rates, the oil price recovered, and in the interim, Karoon was actually able to negotiate a re-signing of the terms with Petrobras. So they agreed to a 380 million initial upfront, so basically half the upfront cost of the field, and they would take control of the cash flows a little bit earlier, and then the rest of the cost would be contingent on where the oil prices would be between over the next 5 or 6 years. So what that meant was that the upfront cost was sort of half what it was, and they could use operating cash flows to repay the rest of the field. And in any case, that would be dependent on the oil price. So they'd only really pay for the rest of the field if the field was making lots of money, which is a terrific deal. So that was another interesting tick. But then what really got me interested was when the founder CEO left the business, and that happened last year. He finally left the business. A few months later, Peter Botten came on the board. Peter Botten, many of you might know, is the long-running CEO of Oil Search, a world-class CEO, fantastic energy executive, and he's been responsible for working in difficult jurisdictions, building a lot of value, and he's someone I've got a lot of time for. So you've got a couple of new and rather famous members of the board. You got the founder gone. You got a new asset purchased at a good term, and then you've got a new CEO coming on. So the new CEO is actually an ex-employee or the ex-head of Shell in Brazil. So he's got a lot of local knowledge, local experience, knows the assets pretty well. And this is not a brand new exploration asset. The field is called Borna, and it's been running for 10 years. It's got all the infrastructure in place. It's got a big, gigantic, what's known as an FPSO. It's a floating processing facility. So what happens there's pipes going down to the oil field. They have a few pumps and injectors that actually extract the oil. It flows through the pipes, goes into the processing facility where it's kind of processed and shipped all on the one site. And so everything's kind of there running. There's very little risk. There's very little that's unknown. There's been lots of data and lots of experience running this field, so it's quite a low risk operation. And there's a little expansion opportunity, an identified field, a small one nearby that sort of Petrobras never bothered with. Petrobras kind of didn't really keep up the capex schedule, so there's a couple of pumps that aren't working. So there are ways that Karoon can come in and kind of immediately start improving the output and performance of the field. They have a good understanding of the geology and the reservoir characteristics. And even better, right next door are two kind of stranded assets that Karoon has found in the past, but never managed to be able to get online because they're kind of out in the middle of nowhere and it's hard to get infrastructure connected. So the longer term plan is actually to connect those fields to the Borna infrastructure and expand the entire project. And if they can do all of that, and these are well understood fields, you've now got good management and you've got financial resources. The field is pumping out cash flow, and it should be more than enough to fund the development work. I think you're looking at about $4 a share in value, and the business here is sitting at sort of $1.20 or whatever. And what's more attractive really is the downside risk is pretty low. Save for a collapse in oil prices, in which case this thing
Famous last words.
famous last words. Indeed.
We saw the price go negative earlier
Yeah.
last year, but that's those are old.
Well, I
Those
think
days are behind us.
anytime you're dealing with a commodity producer, you sort of know that risk. You know you're taking on the oil price risk, and you got to be comfortable with that and allocate the stock in your portfolio with that in mind, right? So
You got to
I don't think
diversify. You wouldn't put
yeah,
all of them. Yeah.
it's not a 10% position size or anything, But what the low risk part comes from the operating and reservoir characteristics. Often an oil field can surprise once you actually get in there. You don't really know how it's going to work. Once you're actually in there pumping,
Surprises doesn't sound that great to me though. If you're buying an oil field, probably
but
want to know what I was buying.
yeah, but once it's been operating,
Mm.
you actually got operating reservoir characteristics. You sort of know what's happening, and it's unusual for something bad to happen in a field that's been pumping for 10 years. It happens, but very rarely. I've rarely come across it. So then, from that point of view, it's relatively low risk. So the oil prices can do anything, and maybe we're back at $20 or $30. In that case, this thing is worth zero. But if oil sticks around at 60 to 70, which I expect it to, I mean, I don't have any real insight into the oil price. I don't know. But I do know that there's been sort of $1 trillion of capex cancelled over the last few years, that there's not many people spending money on oil development and exploration. So I know that's going to be good for prices. And we know that no one really wants to buy Karoon. When you sort of look at people covering Karoon and talk to people inside the industry, Karoon still has an odor about it. And there's a
Yeah.
real reluctance to back a company that's been a bit of a disaster over 2 decades. So there are real signs of change here, and I think now might be the opportunity just to take a nibble and come back and and pick up the stock at an interesting price.
Is the son still the CFO?
He is for the moment, but they've got a new CEO. They've got new board members. I would bet that he wouldn't last long, and he hasn't caused any blow-ups for a little while, so that's good. But that would be obviously be another plus to see like a bit more to see someone else in that role. I'd probably be happier. Yes.
I do like the whole change of management thing, and good directors are jumping on board. That's usually a
Yeah,
pretty
that
good
usually
sign.
that's right. And we're kind of used to watching management and looking for good people in the management positions, but we sometimes forget that the directors actually have a lot of power, and who's sitting in those director roles is super important. And so I've kind of learned to follow directors along as well. Watching good directors come and go is actually really good.
Yeah.
The other thing I've kind of learned, and one of the reasons this is now sitting as a spec buy, is that the market is of course very efficient and very good at incorporating new information and reflecting it in share prices. We know that. What it's sometimes not so good at is incorporating change. And I have noticed that when something changes, the market can be a bit slow to reprice something that has changed. And we've seen that time and time again. I mean, we were banging on about how BHP was just a much better capital allocator, and the market was very cautious about that. And I think now, BHP's over $50 a share. Everyone's kind of on board, and everyone sort of accepts that this is going to be a better capital allocator. There are tons of other examples of change that's happened in businesses, and it's taken a bit of time for that change to be reflected in prices. I think this might be another example of that.
That's a really, really good point. And I guess it's kind of getting to, how do you find new interesting buy ideas in the current market when things are a bit expensive as well, and maybe looking for a bit of change or something where the story is different. Yeah, I think that's an interesting way to think about it.
Well, it is noteworthy that both Lendlease and Karoon have those characteristics in common, don't they? I mean, they've both been bad businesses for a long time, and suddenly something has changed, and the business has changed, and there's an opportunity for that change to be reflected in the share price. Do we have any questions about oil, Brazil, Karoon, Samba?
I have a stupid question, but I don't
I would
know if
expect
anyone.
nothing less, Mickey.
So with because
Mickelson?
I just don't know enough about oil, but
Yeah.
Is
I
it still
guess
taken from whales?
is it as we transition to like electric vehicles and stuff,
Yeah.
that would is that part of like the bear case, or
Yes, I think
yeah.
that's right. Yeah, I think that's correct. Yeah. So one of the things we have to think about now, and this is, I don't think the industry has really grappled with this the way the coal industry has, is that there is definitely a demand shock coming. All major car manufacturers are now talking about stopping the sale and production of conventional engine vehicles, and only doing electric. And once that happens, obviously, it'll be slow, right? I mean, car fleets generally take sort of a generation to turn over. The average age of a car in Australia, I think, is like 11 or 13 years, and it's no different anywhere else in the world. Electric cars for now are more expensive, and in Australia, anyway, in lots of parts of the world, they haven't really taken off in the absence of government subsidies. So, look, I don't think I think it's going to be a slower transition than many people think, but there's no doubt it is happening, and it is a looming shock for the oil industry, which they haven't really addressed or dealt with. So, yes, that's for me a reason to watch your allocation, rather than a reason not to invest.
Yeah.
But yes, it's an important point. Thanks for bringing it up.
Do you know how much oil use goes towards cars versus things like fertilizers or plastics and the rest of
Yeah,
it?
it's most. Oil is largely a transport fuel, so I think it's like 70% or something goes to transport, and the remaining goes to petrochemical industry. So it's a big deal. Yeah. So even a smallish change to the electric fleet will be reflected in oil prices over time. Yep, it is a really important deal.
Is that part of like because again I don't follow the oil industry that much, but is that sort of reflected in prices? Do you think across the industry, like is oil out of favor?
Oil is certainly out of favor. You've seen the oil price. I don't think it's reflected in the oil price, but it's certainly reflected in equity valuations.
Hmm.
The oil price is actually pretty good by historical standards. It's maybe slightly above at the longer term average, or the recent average anyway. And you'd expect all equities to sort of be priced a lot higher, and they're not. So Woodside at sort of 75 oil really should be close to $35 or $40, and sort of trading at half that. Now Woodside has its own problems. It's going to raise capital. The market knows it's going to raise capital, and so the price is staying a bit low for that reason. But all other oil search should probably be about $6 really, and it's sort of $4. It's across the industry. The big guys in the US, because their valuations are being held back, they're actually just pumping out dividends. They're the biggest dividend payers in America at the moment. And the shale guys, who traditionally have been the cowboys of the industry, these guys pumping reckless amounts of shale oil with disregard to the financials. These guys are sitting on billions of dollars of losses while increasing production. That's now totally reversed. And you've got the shale industry now holding back on production and trying to pay dividends because there's a recognition that the only way to get, or the best way to get returns to shareholders is not really through expanding output, but through dividends. And so the behavior in the industry kind of reacts to the changes in the industry. So you're seeing a self-imposed discipline on the supply side, and that should help everyone stay profitable. But the days of sort of $100 oil, I think that's very unlikely. So we're dealing with probably a oil price that probably won't spike to the levels that the peak oil guys were talking about sort of a couple of years ago.
Mm.
But
Yeah.
the oil price is certainly the obvious risk here.
It's just
Right.
so hard to pick them, the prices.
Yeah, well, no one
Oh,
really
you mean
knows.
pick the price?
Yeah.
No, I
I thought you
meant
meant pick the risk.
Oh, right. Oh, you pick the risk to
Now,
play
note that it's
between.
a spec buy. It's not for everyone, and it's only a small allocation. But it's hard finding interesting ideas. I think this is one of them. Graham, let's move on to a stock you've been looking at for a while. In fact, one that's been wildly successful, and I'm not sure anyone owns it, and we certainly haven't been talking about it very much, which is Credit Corp. You recommended upgraded this, I think, last year. The share price is probably more than doubled by now. It's got a long history of wonderful operation. Two of its key competitors are on their knees, if not dead, and they've got a expansion in the US that's coming along quite nicely. They covered off their results. I'm more interested, though, in how the business is progressing. So maybe just for those who don't know, explain what the business quickly does, and then tell us where they are at the moment.
So Credit Corp, I think we mentioned last week we were talking about this idea of having a SIN portfolio, and Credit Corp would have to be at
Oh,
the
I
top
love
of
it.
the list.
Hey, hang on. It's not at the top of the list. There's a little company called Whitehaven that probably belongs at the top of the list.
Hey, Graham. I mean, the banks need their money somehow. I mean,
Yeah, I don't
it's
see.
not going to
I
go
don't.
collect itself.
Yeah, I don't see the. I don't see it as being as terrible as. I mean, it's playing a role in society. If you feel that people don't have to pay back their debts, then that's one argument. But if people are defaulting on their debts, Credit Corp goes about collecting them using non kind of predatory tactics. I think it calls you a few times, sends some letters, and then that's about it. Whereas some of the others will be more likely to take you to court and really make life miserable for the debtor or for the borrower. But yeah, Credit Corp has a pretty good history. It doesn't have any regulatory actions against it, or it has a below average complaint rating. So in terms of debt collectors, which are never going to be the most popular, glamorous
I
stocks.
just got this mental image of someone at a barbecue saying, "Oh, so why did you buy Credit Corp? Because it's got a below average complaint rating." Obviously.
No regulatory actions this year.
Yeah. Woohoo. And then they
Well,
high
that is
five each other.
that is a
Yeah.
pretty good sign, though, because in this kind of industry, you'd think that regulatory issues would be pretty common, wouldn't they? So
Well, that's the thing, is it's probably the most complained about industry, and it does the management, who I have a lot of respect for, feel that that is one of their competitive advantages, kind of being the good guy in a sense among debt collectors, because especially over the last kind of 5 years, there's been a lot of scrutiny of the banks and different lenders, and so they don't want to associate anymore with the more predatory debt collectors who might have got them an extra cent or something or other per dollar of loans outstanding, but then you end up upsetting all of these people, causing all of this pushback, and then it reflects badly on ANZ or Westpac or whoever's actually selling the debt.
Mhm.
So yeah, the Credit Corp's been run pretty well, and it's over the past 13 years or so since the current management has been in place. They've got a very good track record of not chasing uh, mediocre returns, which is very tempting in the debt collecting industry, because the way that it works is a bank will have a whole portfolio of written off loans where the people have defaulted 6 months ago. Then it'll collect these up, say $1 million worth of loans, and it'll sell them to the debt collectors. And there's usually only a few working in each jurisdiction, which then bid on it in an auction process. And so they might buy, say, $1 million worth of theoretical loans for $10,000 or something or other. And then their job is they purchase it at rock bottom prices and try and reclaim kind of 20 grand worth of loans out of it. So there's always a temptation, kind of like the construction industry, where you want to overbid. It would be very easy for Credit Corp to double its market share overnight if it just paid a little more for the loans that it's purchasing.
Yeah.
But it doesn't really have that history. Instead, you've got this history of nice, stable margins, and you've got collections always coming in ahead of what they paid for the actual ledger. And so it's not only responsible on the collection side, but it also has a very responsible management in terms of the purchasing side, which is where the biggest risk is. That's where a lot of other debt collectors have ended up going bankrupt, because they'll overpay for the loans and they can't collect as much as they had paid for them, and you end up losing money out of it.
It is actually a really impressive characteristic, because when you think about it, the urge from management to drive profits is really insatiable across most businesses, and it's very easy to accomplish here. You just have to go out and buy more stuff, and you can recognize the profit up front, and then you deal with all the the costs and the risks further down the line. So I guess
Yeah.
that's why the competitors have gotten into trouble. They've fallen into that trap.
Yeah, you're exactly right. It's one of those businesses where you can take on a lot of risk today, make your books look really good, and then it's only someone a few years from now who has to wear the pain. But yeah, Credit Corp doesn't do that.
was it the CEO? Is it did he found the business, or is he?
No, he
Just
came in 2008, and yeah, he's had a good history with the company. He led it through the financial crisis, has led it ever since, and I'm trying to remember whether he has a large ownership stake. I don't think so, which is another one of those interesting characteristics where most of these companies you would have, well, the good ones would have a CEO that has a large stake in the business. But yeah, I don't think that the
could
current
just be
CEO does.
like a cultural thing as well. It just seems like I think about Berkshire, for example, like their insurance arm and how they kind of think about risk and stuff like that. Could just be a slightly different way of approaching things, or is that what's happening? Or
Well, he does seem to be just good. When you see interviews with him, he's always just very intelligent, well spoken. Seems like a very able manager. There's performance pay, so I mean, he does get compensated when he performs well.
I was about to ask you about
which
that. Right. So, so what? Can you just go into that a little bit? So it's because it's very unusual for this kind of behavior to be going on for such a long time. I just want to see what are the kind of incentives that are driving it. So I was going to ask you whether there's a lot of equity, but it sounds like there's some other mechanism at play. Do you mind just
Yeah,
going into that a
there's
little?
not a lot of equity, but there is various types of performance pay. I think by memory, it's around half of his overall pay ends up coming from performance
Yeah, right.
characteristics.
Okay.
Uh,
That is, yeah, that's quite a bit. And that's an annual thing, is it?
in terms of what do you
So,
mean? Is it an
do they measure that over a 1 year period, or is it over a multi-year period and it kind of vests over time?
that's a great question. I can't remember. I'm not sure. I imagine that
Mm.
it would be over
It
a
must be over
period
time.
because
You've got the evidence there, don't you? Yeah, over a long period of time. Yeah.
when you're buying these loans, if they're measuring it properly, then it can take 5 years to end up
Yes,
getting
that's
every
right.
last penny out of it.
Yeah,
So
yeah,
I don't think it would be based on 1 year.
yeah,
It's
yeah.
probably returns on capital, if anything.
Okay, yeah. And so Graham, it has this wonderful record of performance. It does better than its peers. Um, Tell us what's happening in the US, because that's they've identified that as a new engine of growth. How are they going over there?
Really well. It's been interesting to follow because they only started moving over to the US when I first started following the stock
Mm,
back in kind of 2013 or so. And for the first few years, it was terrible. It was loss making. There was nothing really going on. But they seem to have really hit their stride over the past few years, and it's been growing much more. I think they just had to build their reputation. Essentially, they've now got more lenders uh,
mm.
on the ledger panels, uh, and they've built a reputation. So they're already the sixth largest debt collector over there, which is pretty
Yeah,
incredible to go
right.
from zero to that in less
And
than a decade.
that's without any acquisitions. That's just building up their organic business.
Yeah, and
Right.
just expanding through office expansions and hiring more staff.
Mm.
It's a very favorable market for debt collectors over there. So it's much more favorable on the regulatory side and also on the legal side, though, from what I know, Credit Corp doesn't actually pursue it legally very much in the courts. But there are a
Are you
few other
saying, Graham,
debt.
we will never find a TV show with muscled up debt collectors from Credit Corp banging down doors?
Maybe Credit Corp just doesn't get caught and their goons are hiding behind the scenes.
That's exactly what came to my mind too, Gaurav. I was just,
They're all
we
American,
need
right? They're like the
handlebar
laws.
mustaches.
Handlebar mustaches, yes.
Yeah. No, they seem to be, but yeah, the US market is favorable in terms of all of those different characteristics. But it's also 10 times larger than Australia, so
Wow, really?
there's a
Okay.
lot of potential for growth there if they
And
keep doing well.
and is it a national market or is it a regional market? So do they have a big market share in a small part and they have a difficulty kind of breaking into the rest of it, or is this kind of like a big national rollout?
No, it's across the whole nation because they're dealing mainly with the large bank lenders, which have debts everywhere.
Okay.
It's mostly credit card debt, and these days it's not someone knocking on your door trying to reclaim a debt. It's all done either over the phone or by letter.
Hmm.
So yeah, there's not specific markets. I think different states end up being more favorable on the legal side, which is why Credit Corp operate in the states that they do.
Hmm.
But I'm not sure whether that would make it kind of a local market. I'm pretty sure that they deal with people out of state as well.
Okay. So I've got a obvious question, I think, Graham. You've described actually a really good business that has a terrific track record and fine operating metrics. We'd call it a high quality one, right? And it's got a foreseeable avenue of growth, and it's trading at just 20 times, which I know in the past may have been high, but today that looks quite cheap for me. And I'm like, why isn't this on the buy list? Why aren't we buying it now?
Well, we did buy it at half the price.
That's true.
um,
That's true. That's a good
so,
answer.
yeah, maybe we should have been buying it for a bit longer, and that was probably just conservatism that got in the way.
Hmm.
But you're right; it is a good business, and
Are the
but I
multiples?
think
I mean,
Are there risks that worry you about it, Graham?
yeah.
or-
So that's the thing is that you can't just look at it at 20 times, compare it to something like CSL, and say, oh, therefore it's good at this valuation.
no, I'm just
There is a
crossing.
lot
I'm
of
just crossing that strategy off my playbook. Hang on a second.
yeah. There are these kind of long tail risks from it. So if you look at something like the financial crisis, or even what we just kind of went through, it could have gone a lot worse because they're already buying they're already buying debts that people have defaulted on. So you are getting not just subprime borrowers, but the people who don't intend to pay back the money. So if you own a huge book of these debts, going into some sort of financial crisis or recession,
Yeah, right. Okay.
the odds of you reclaiming what you paid are like dramatically lower than any other kind of lending.
Okay. I understand. Right.
So yeah, it's the kind of thing where it can look like it's doing very well for a long time,
Uh-huh.
and then when you get these big hiccups, it ends up being a disaster. But you can only lose so much money, and Credit Corp, to its credit,
Put that on put that on the headline. You can only lose so much money.
yeah, it has a downside similar to Karoon Energy.
Oh dear.
Well, I guess the thing though we learned from the pandemic as well is just that when these crises hit, I mean the government isn't just going to let people go broke. Do you think that changes things at all, or
Well,
you wouldn't?
that's what I've learned so much from this crisis is that it has behaved so unusually for Credit Corp, FSA Group, a few other small lenders that would have benefited from kind of a recession or something negative happening. So in Credit Corp case, although a recession is going to impact it a lot more because it won't be able to reclaim the money that it has on its current book, because it's a supply and demand for the ledgers themselves, as there's a lot of more people defaulting in a recession, the banks are selling a lot more ledgers, which then pushes the price of those ledgers down during those auction processes. So although it might have higher defaults on its current book, it ends up purchasing its new ledgers for much lower prices than it was before. So it ends up kind of like a baker or something suddenly finding the price of flour drops 50%. It might be bad now if that impacts or if that's a reflection of bread prices going down. But
Mm.
over the long term, you've then got all this flour, which is dirt cheap, and you can sell it hopefully in the future for a much higher price. So yeah, but what this crisis has kind of shown me is that it can be too bad in a sense. So what you would have expected to happen over the past year was that ledger pricing would go down, they would have a higher rate of defaults, but then they'd end up filling their books with ultra cheap debt ledgers they could then collect on in the future. Instead, what happened is people weren't defaulting on their credit cards. Savings rates went through the roof. Government stimulus put all this cash in people's bank accounts. And so there was this kind of dry spell of ledgers where the banks didn't have enough debt to sell. The complete opposite of what you would have expected to happen in a recession. So, yeah, we're now coming out of that now where the supply has picked up again and Credit Corp is putting its foot on the accelerator and buying up lots of cheap debt again. So that sets it up well for the next few years. So it might end up being a positive overall that it didn't have many defaults during the actual recession, but now it's got a bunch of cheap debt that it's able to collect on in the future.
It's a good idea. I
Yeah.
like it. I wish I'd bought it earlier. I'm not quite sure. I guess back when it was upgraded, there's just a lot of upgrades going around. Lots of businesses available, lots of choice, and probably know now that next time we have that scenario, I mean, that sounds like the perfect time to pick up Credit Corp, right? When it goes through one of these conventional downturns and one of these crises pop up.
Yeah,
The
there's
next
always
time
a
this
bit of
thing falls.
hindsight bias because it was, I mean, in hindsight, we know that it doubled over the following year, but at the time, it was still an uncertain recommendation in the sense of, I mean, we upgraded it because we thought it was undervalued at that price, but we didn't know that the following year there was going to be so much stimulus that people wouldn't be defaulting on their debts or anything
Yeah.
like that. Who
Yeah.
knows how it would have turned out if that had been different?
Mm.
Yeah, so you
No.
can't beat yourself up too much for not buying it when it was the best time to buy.
All right, put down my bat and ball. Now, I think that's all we have for it. Anything else to add, Mickey? Anything? Do you own Credit Corp, Mickey?
No, I don't. But
You don't own anything
after
that's gone
that,
up.
after that conversation, I wish I did. It sounds like a really good business.
All right. Well, we got reporting season going on at the moment. So let's get on with that. Just quickly, gentlemen, what are we all working towards or looking at the moment? Mickey, you've got what company reports are you looking at?
Oh, geez, you've exposed me. Well, I just wrote up ale yesterday, and
Yeah,
I think
saw that.
I don't have anything. I've got a couple companies reporting next week, so I'm going to spend the next few days just kind of getting to know a few new businesses that I'm looking at. But don't want to spoil the surprise. So
Very
yeah.
exciting. Okay. Graham, how about you? What are you looking at?
I've got ResMed coming up tomorrow, I believe,
Mm.
so that will be next on the list. And there's Transurban, and then I've got the busy couple of weeks after that.
Yeah,
when
I've
all
got...
of mine inconveniently report at the same week.
Oh, don't you? I've got that as well. They all kind of report at the same time. I would wish they'd space these things out. Don't they do this with us in mind?
I know. Very selfish behavior.
I've got, I think Telstra is the one. Telstra and probably TPG are the two I'm quite looking forward to getting into. TPG just has been gone silent and said nothing about how they're going. Now, we know they've got a wonderful fiber business, but that's probably been hit by the pandemic as offices have largely shut in population centers. And I suspect they're doing quite badly in mobile, which explains the the silence. So I want to see what those numbers look like. On the other hand, I think Telstra is actually going to report reasonably well for the first time in a long time. So that's an interesting one as well. BHP may have the best result of the season, that's going to be a pleasure to cover because it's just going to be wonderful big numbers all spewing out of that company, and the decision is actually going to be when to take profits and when to sell, which is going to be a tricky one. But there's lots of... This is looking really like a quite good season so far. I don't know if you guys feel the same way, but looking at my companies, I think I can't see too much going wrong, really. Famous last words. And
Yeah.
and I'm quite looking forward to getting into it. It's all looking pretty good. But then again, I don't cover Sydney airports and Flight Centre and stuff. I don't know. I kind of like reporting season. I find it
I
quite
like the pressure.
fun. It's only a
Yeah.
short, concentrated amount of pressure. I wouldn't want it to
It
happen
does
all year
make it
round.
more interesting. Like you go through 6 months where not much happens, and then all of a sudden everything happens. So
Yeah.
it does. You've got plenty of interesting things to read about, and it is a lot of writing and work basically.
It is a lot of work. But Mickey, if you're in Sydney, there's nothing else to do. So I'm happy for all the work. And I hear, like, you got a couple of cases in Victoria. You're going to be in lockdown by the weekend, no doubt. So you're going to have plenty of time.
We tried to let you guys have the crown, but we're taking it back off you. So we're undisputed lockdown champions.
No,
I reckon.
undisputed. That's right. No one's going to take that from you.
We're working hard to keep it. That's for sure.
Okay, Mickelson, good to have you on board.
Thank you.
And Graham, thanks for joining me.
Thanks, Gaurav.
For everyone else, thank you for listening.